Welcome to The Explainer. Today, we are breaking down a massive divergence between the market headlines you're seeing and what the underlying data is actually telling us. It might look like a rally, but believe me, the smart money is moving in the exact opposite direction. Okay, let's just dive right into this, shall we? On the surface, things look pretty good. Stock markets are surging, oil prices are coming down. But when you peel back that first layer and look at the physical reality of our global supply chains and the, frankly, tectonic shifts happening in monetary policy, well, the data tells a completely different and way more dangerous story. So what on earth is going on? The answer to that question is something we're calling the normalization trap. It's this powerful illusion that everything's going back to normal, but it's actually masking these incredibly deep structural shocks. And today, we're going to break down exactly how this trap is being set, using data straight from the source. So first, you have to understand the illusion itself. And it's built almost entirely on the market's desperate hope for a super quick, clean end to the conflict that's been raging in the Middle East. This statement from the White House was the trigger. It suggested the entire geopolitical crisis, the one that's paralyzed global shipping, would be over and done with in just a matter of weeks. And the market? Well, it heard exactly what it wanted to hear. And the reaction was just immediate and totally euphoric. Traders priced in this rapid resolution almost instantly. You had Brent crude plummeting over 15%, dipping below $100 a barrel. At the same time, risk assets, everything from the Nikkei in Tokyo to the FTSE in London, just soared. It was a classic relief rally, all built on a single optimistic headline. Okay, so that's the illusion. Now let's get into the first part of our reality check, because this paints a completely different picture. We're going from the headlines to the hard physical reality of the global energy supply. And what's really fascinating here is the hard data from the International Energy Agency. It's just a stark contrast to the market's optimism. We're talking about nearly 10 million barrels of oil and liquids per day just gone from the market. This isn't some future forecast. This is the IEA's estimate of what's already been shut in. The taps are physically turned off. And let's be absolutely crystal clear about the scale here. This is not a minor event. This is not a temporary hiccup. The world's leading energy authority, the IEA, has put it in writing. This is, and I'm quoting here, the largest supply disruption in the history of the global oil market. It's a historic, structural break in how the world gets its energy. Now, underpinning this entire crisis is a massive structural shift in U.S. foreign policy. Sources are calling it the Donroe Doctrine. To put it simply, it's about America stepping back from its role as the world's maritime police to focus on its own backyard. This creates a huge security vacuum in critical areas like the Persian Gulf that the market is just completely ignoring right now. This table really breaks down the shift perfectly. Just look at the primary goal row. The original Monroe Doctrine, that was defensive. It was about keeping European powers out. But this Donroe Doctrine is offensive. It's about actively excluding rivals like China, Russia, and Iran. And look at the shift in enforcement. It goes from just a warning to active military pressure. This isn't a temporary disruption, it's a long-term strategic pivot. The U.S. is focusing on our hemisphere, and that means it's structurally withdrawing from guaranteeing security everywhere else. So, you've got this massive physical supply shock, but that's only half the story. The second shockwave hitting the global system is all about money, and it's coming from the East. The world's financial plumbing is, well, it's backing up. You see, for years, a huge part of the global market has been fueled by one thing: ultra-cheap money from Japan. It's called the yen carry trade. It's basically been the world's biggest source of free money for speculators. Investors borrow yen at almost zero interest and then plow that cash into higher-yielding assets all over the world. Think U.S. tech stocks, crypto, you name it. It's been a river of cheap liquidity for a long, long time. And the scale of this thing is just staggering. We are talking about an estimated $4 trillion. That's $4 trillion of liquidity that has been artificially propping up global asset prices, and now it's all being pulled back as this trade unwinds. And here's the crucial point. That free money engine is being switched off. The Bank of Japan has hiked rates to 0.75%, which is the highest it's been in 3 decades. This forces all those investors who borrowed cheap yen to now sell their global assets, their stocks, their bonds, their crypto, to pay back those loans. This isn't some small adjustment. It's a massive reversal of capital flows. And this leads us to this huge widening gap. While Japan is slamming on the monetary brakes, Its neighbor China is stuck in the complete opposite scenario, a deflationary trap. The People's Bank of China is holding steady, choosing stability over stimulus. This creates this extreme, unpredictable policy divergence in the world's most important economic region. It's like you have one massive engine reversing course, while the other one is completely stalling out. So what does this all mean for you? Well, this new environment, one of physical commodity shortages on one hand and tightening money on the other, it requires a completely different investment strategy. The old playbook? It's obsolete. So in a world of physical shortages and tightening money, where can capital even go? Well, the data is pointing to a commodity with its own extreme, well-documented structural imbalance, silver. The silver market has been in a physical supply deficit for 6 straight years now, and that's completely independent of all these new shocks we've been talking about. And this isn't some cyclical deficit, it is structural. It's being driven by what's called inelastic demand, which just means demand that doesn't really go down even if prices go up. And it's coming from the biggest technological revolutions of our time. We're talking solar panels, electric vehicles, and the massive hardware needed for AI data centers. This demand is relentless, and it is overwhelming what the mines can actually produce. Now, this is where it gets really interesting. Look at the range of outcomes the big analysts are predicting. JP Morgan has a baseline target of $81 an ounce, but the bull case from Bank of America is a staggering $309 an ounce. That massive spread tells you everything. It highlights the potential for an absolutely explosive move if this deep physical shortage finally breaks the paper market that sets the price. So we end with this critical question. The market sees a relief rally that's based on a hopeful headline. The data, on the other hand, shows a deep structural break in both the physical world of energy and the financial world of money. The normalization trap is closing, pitting wishful thinking against hard data. The only question left is, which reality is your portfolio actually prepared for?